Good afternoon and welcome to today's Telematics Accounting broadcast. I hope the March results was very good for the accounting learners, but there's always room for improvement. So what we're doing today is a little bit of revision of the first term work, which is generally cash flow. Learners, we find a problem. We see that learners tend to struggle with the cash flow statement. So today we'll be doing activity 1 from the learning book, activity 1. And you have the answer book as well. So it's activity 1. And then you'll have the answer sheet together with that. Okay? But before we go to the answer, let's first have a look at the cash flow statement regarding the information that they give us. So the first part on top, we can see it says it's an extract from the income statement. Okay? So this information over here, that is the part that appears in the income statement. So some of these items we will be using, and I'll be marking them with the asterisk, which is normally the depreciation, the interest on loan, net profit before tax, and we're going to need the income tax. So that's the income statement information. Then also, they're giving you balance sheet information for 2 years. Last year was 2013, and the current year is 2014. So it's very important, learners, that you must know where to find the information that you're going to need to draw up the income statement. Okay? And then always, you must check to see if they give you any additional information. Like in this case, they give us notes to the financial statements. There's a note on the fixed assets, there's a note for cash and cash equivalents, and there's a note for ordinary share capital, the issued, the retained income, and very important, there's a note for trade and other payables. Okay? So we're going to look at all these information. Why do they give us this? So that eventually we can draw up the cash flow statement on the answer sheet provided. Okay? So there we go. Here we have the notes to the cash flow statement, which is generally the first note for the cash flow, and they'll always be asking you that. Either to draw it up from scratch or partially complete it, and then you will just have to fill in. Okay? Very simple. The very first line, it says net profit before taxation. Okay? So the net profit before tax, that information you will find in your income statement. So in your income statement that we circled earlier, we are looking for the net profit before tax, which is 420,000. So that figure we'll take straight away, no adjusted, just like that, 420,000. Right? So your net profit before tax, that's the item that comes from the income statement. Sometimes what they do, they give you the net profit after tax. Then you're supposed to add the tax to get to net profit before tax. But in this example, it was the straightforward. You just have to take the net profit before tax from the income statement and write it in. Okay. The following line, it says adjustments in respect of. So this is where we have to write in those items that we marked earlier in the income statement. The first one is going to be the depreciation. That you'll also find in the income statement. And that depreciation figure is 71,000. That now includes the depreciation on vehicles and the depreciation on equipment. So it's 71,000. Right. Next item, we're going to call it interest expense. Remember, in your income statement, although it says interest on loans, in your income statement, there's a separate line at the bottom regarding interest expense. So when we take it from the income statement, we will call it interest expense, and in this case, the amount is 53,000. 53,000 is the figure that we'll write in just like that. Right. So just to recap quickly, net profit before tax, We get it from the income statement, 420,000 as it is just there. Then the next item is going to be the depreciation, 71,000. They call it interest on loan, but when it comes from the income statement, we're supposed to call it interest expense. So we have the 53,000 as the interest expense. Then the next line will just be the sum of those three figures together. Right, so on the calculator, so it's 420,000 plus 71,000 plus 53,000. And that gives you 544,000. Right. Next line says cash effects of changes in working capital. So for working capital, there will be three lines. So we will call it changes in inventory, changes in the receivables, and changes in the payables. We can also call it debtors, creditors, and the first one is stock. Okay. So inventory, receivables, and payables, those are all balance sheet items. So for those figures, we'll have to look at the balance sheet. Okay. We're looking for inventory, which appears under current assets. We're looking for trade and other receivables, which appears under current assets. And the last one we're looking for will be trade and other payables, which appears under current liabilities. Now, very important, learners, if there is no note to any of those items, then we only have to use the figures in the balance sheet. Okay? Again, if there are no notes for any of these figures that we marked with the asterisk now, then we only use the figures straight from the balance sheet. For inventory example, there's no additional information regarding the inventory. So we have to use the figures straight from the balance sheets. So I'm looking at inventory. Last year there was 185,000. This year my inventory increased to 237,000. So those are the two figures that I'm going to use to record it in brackets over here. So the inventory, last year it was 185. And this year the inventory is 237,000. Okay. Now what happened to the inventory? The inventory increased. Therefore, that will be an outflow. Why did the inventory increase? Because we went to go and purchase inventory. We went to go and buy inventory, so money will be spent. So the difference between those two figures will have to appear in brackets. Okay, so on your calculator, it's just the difference between 237,000 and 185,000. That will be 52,000, which will be an outflow. That's why we have the amount in brackets. Okay. So just again quickly, for inventory, it's just the difference between the 2013 figure and the 2014 figure. The difference between the 2013 figure and the 2014 figure. Right. When we get to receivables or to debtors, what we need to check, which is very important, learner, if there is perhaps a note regarding receivables or a note regarding payables. Again, if there's no note regarding receivables or payables, then we have to take the amounts straight from the balance sheet. In this case, there is no note for receivables, so all we have to do we have to take the difference between those two figures in the balance sheet. Okay. No note, so we have to take the difference between those two figures in the balance sheet. So my receivables, it decreased from 98,000 to 72,000. Right, so that's all the figures that I'll have in brackets next to my note. So last year, the receivables was 98,000, and this year the receivables is 72,000. So my receivables decreased, meaning that the debtors settled their accounts, so this will be recorded as an inflow. And an inflow generally goes without brackets. So it's just the difference between 98,000 and 72,000. And that gives us 26,000. Let's check if there's any questions on that. Okay, that's not us. Okay, so once again, quickly, for receivables, no note. So we go straight to the balance sheet figures and we just take the difference between the previous year's figures and this year's figures. And the receivables decreased from 98,000 to 72,000. So we received money, so it will be recorded as an inflow. Right, then the next one will be we have to go to the payables. Again, we're looking at the payables at the bottom. So we need to check if there is no note explaining those two figures, then we have to take the figures in the balance sheet as it is. But if we look at the additional information given, there is a note regarding the trade and other payables. And there is something extra which is very, very important. Okay, this one over here. Okay, it says expenses payable, interest on loan. So normally what we do, we only discard SARS and shareholders. But in this case, because it says expenses payable and it mentions that interest on loan is one of those expenses, or that's the only expense, we have to discard all three of them now. So we have to discard all three of those items. We have to discard the shareholders for dividends, because later we'll use those two figures to calculate the dividends paid. We have to discard the SARS balances, because later we'll use it to calculate the income tax paid. And because they give us the interest on loan, which means everything wasn't paid, so now we'll have to use those two figures to calculate the interest paid. So now receivables will only consist of these two items, which is the 114,000 and the 7,000, which is trade creditors, and income received in advance. So that gives me 121,000. And on this side, it gives me 69,500. Now we have to get the difference between 121,000 and 69,500. Just to make sure everybody understands, normally we only discard the SARS balances and the shareholders balances. But because they are mentioning specifically interest on loan, you will discard that one as well. So now we have to exclude the 6,000, the 13,000 and the 240,000. That's for the 2014 as well as for 2013. Don't take the interest on loan amount, so you only take the first two figures, which is the trade creditors and the income received in advance. Those figures, later on when we do the cash flow, we'll be coming back to them to use them in our calculations. But for now, for the difference between the payables or the creditors, we only have to take the figure of last year, which was 121,000, which we got by just adding the 114 and the 7,000. And the figure for this year is 66,000 plus 3,500, which gives me 69,500. Right. To see if there's any questions on that quickly. Okay, an increase in inventory is always in brackets. Yes, if our inventory increase, it means that we are purchasing, so we'll be spending money, it will be a cash outflow. Okay. Just again back to the payables. It's the difference between 121,000 and the 69,500. So our payables are decreasing. It's a decrease. That means it will be an outflow. Meaning that we paid. So we paid the difference. So once again, if it's an outflow, we have to indicate the amount in brackets, and in this case it will just be the difference between 121,000 and 69,500. So it's 121,000, 121 minus 69,500. We're going to get 51,500. Okay, let me just mark this one here. That was now something different because the payables, just back to the note quickly, the note for the payables, because they indicated that the expenses payable is interest on loan, so we have to discard that as well. So you're discarding the interest, the expenses payable, the SARS balances, and the balances of the shareholders. So the only items left will just be the difference between the 69,500 and the 121,000. So that's why my bracket shows 121 minus 69,500. And there you can clearly see that you owe the creditors less, meaning that we've paid them 51,500 for the current year. Okay. Then all we have to do over here in this block, we now have to offset those three figures to get the amount on top. Okay. So we start with the positive number, and the positive number is 26,000, and then we just minus the negative numbers, or the numbers that's in brackets. It's 52,000 and 51,500. Then the answer on the calculator is a negative, meaning that that figure 2 of 77,500 will have to go in brackets. Okay. Okay, no questions there. Right. Again, so we offset the three figures in the table over here, that's in brackets. So I started with the positive number. So it's 26,000 minus the two negatives, gave me a negative of 77. Then I offset those two numbers to get the final answer over there. So that will be a calculator. So it's 544,000 minus 77,500. That will give me 466,500. I see this, we have a question here quickly. When payables increases, is it an outflow in the business? When the payables increase, in this case the payables decreased, so the opposite will also be true. In other words, if payables had to increase, it would have been an inflow because we received on credit. Okay? The opposite for all of them will then be the opposite for, yeah. So if my inventory decreased, it means that we sold inventory, so we'll be receiving money, so it would be an inflow. But in this case, my inventory increased, meaning that we bought inventory, so it will be an outflow. Right? Once we have the answer of the note, it says cash generated by operations. So that is the first figure that I have to transfer to my cash flow over there. So that should be 466,500. That's what that is. Okay. Right, so that note is done. So now we're looking at the cash flow itself. So we're finding that the cash flow is divided into 3 sections, which is cash effects from the operating activities, the cash effects from the investing activities, and then the last section will be the cash effects of the financing activities. Okay? So this is where we will have to fill in all the items that we're supposed to know by now, and then hopefully we'll complete the cash flow. Okay? So for the first item, it's going to be interest paid. Okay. Let me mark this one also. The interest paid and the interest expense. In most cases, it will be the same figure. In most cases, the interest expense and the interest paid will be the same figure. But in this case, and very important, learners, because they gave us expenses payable, interest on loan, those two figures, meaning that last year we never paid 8,500, and this year we never paid 6,000. Okay? That means those two figures will now affect the amount of interest that we actually paid. Okay? Again, if that figure if there was no bracket telling us interest on loan, then we only had to discard the SARS amount and the amount for shareholders. But because they specifically mentioned interest on loan, we discarded the interest on loan. Now we'll be using the interest on loan. Okay? So the interest expense in the note and the interest paid in the cash flow, in most cases, they are the same figure. But because of the extra note, that will now not be the same figure. So how do we start with the interest expense or the interest paid figure? We first of all have to see that how much do we still owe of last year. So we owe 8,500 of last year. So that will be my starting point. Owe the 8,500 of last year. So surely the 8,500 of last year I'm going to pay this year. Together, so I'm adding with whatever the interest expense amount is for this year. The interest expense amount is 53,000. So I'm taking my 8,500, the balance of last year, plus the 53,000, minus the amount that I haven't paid for this year, which is 6,000. And then we close the bracket. Okay. So again, the 8,500 was the balance or the expenses payable on the interest on loan that we never paid last year. So that portion I will have to pay this year, together with the interest expense figure that appears in the income statement for 53,000. Then minus the amount for expenses payable of this year. So that bracket next to the interest paid will be 8,500 plus 53,000 minus 6,000. That will give me 55,500. Okay. So it's the 8,500 plus the 53,000 minus the 6,000, and that will give me 55,500. I put them in brackets because if I'm paying, it will be seen as a cash outflow. Okay. Okay, it looks like everybody's got that. Okay, the next item is going to be the dividends paid. We pay the dividends over to the shareholders. That is why we have to look at the shareholders. That is why earlier, when we were looking at the note for trade and other payables, we did not use the SARS amount and we did not use the figures for the shareholders, because we'll be using them now when we calculate the dividends paid, the tax paid, and for that matter, the interest on the loan that was paid as well. So now we have to look at the dividends, which means we have to look at the shareholders for dividends, because we pay the dividends over to the shareholders. So again, they're giving us a figure of last year. So we haven't paid that of last year. So my bracket will start with 153,600. So that will be the balance of last year that I will have to pay this year, together with any dividend that was declared during this year. So there we have a dividend in the note for retained income. It says dividends for the year, meaning interim and final. That's together. So together, the interim and the final dividend make up 312,000. So my dividends will be the opening balance of the shareholders plus the 312,000. That's the dividend for this year that was paid and declared. But what we're looking for is only the paid portion. We haven't paid the 153 of last year. We've declared a total dividend of 312,000 for this year, and we also haven't paid 240,000 for this year. So where do we find the 240,000? That wasn't paid last year. There we find the dividends, the total dividend for this year, and also we haven't paid that 240 for this year. So my bracket will be last year's opening balance of the shareholders plus the total dividend minus the closing balance of the shareholders. So for that it's 153,600 plus 312 minus 240. And the dividends paid will give me an answer of 225,600. Once again, it says paid, so I have to indicate in brackets because it will be seen as a cash outflow. The last line under the operating activities will be the tax paid. Okay. So once again, we look at the payables note. Very important note. Again, if they mention the interest, we don't take the interest. They mention the shareholders, we didn't take the shareholders. They mention SARS, we don't take them now, because now when we're doing the cash flow, we'll be using all of those figures over there. Okay? We're using the interest figures to calculate the interest paid, the shareholders figures to calculate the dividends paid, and the SARS figures we'll be using to calculate the tax paid. So we owe SARS 9,000 of last year, plus the income tax for this year. Now the income tax amount is 126,000. So that 126,000 we'll be adding. And we still owe them for this year 13,000. So we have to minus the 13,000. And then we close the bracket. So again, just quick to the calculator. So it's 9,000 plus 126 minus 13. Gives me a figure of 122,000. So again, we have that interest paid figure not being the same as the interest expense figure because of the item under the payables. We have the shareholders over there and we have the SARS income tax figures, and that we use to calculate the dividends and the tax paid. So all we do now, we have to offset those 4 figures that's in brackets and write the net effect on top, which is the 466,500 minus 55,500 minus 225,600 and minus 122,000. And that gives me an answer of 63,400. Okay. So there we have the cash effects of the operating activities, which is 63,400. The cash generated comes from the note, the first note that we did on top, then the interest paid, the dividends paid, and the tax paid. We offset those 4 figures and we get the net effect of the operating activities and write them in line with the words cash effects of operating activities. Okay. The second section of the cash flow talks about cash effects of investing activities. Okay. Again, there's 3 lines. So the first line will be fixed assets purchased, fixed assets sold, that will be the asset disposal, and the third line will always have to be something to do with investments, or which is also called a financial asset, which is over there. So it looks like the investment increased, so it's going to be investments increased. Okay. So we'll have to look at all that information, the fixed assets, to get either the fixed assets bought or purchased, the fixed assets sold, and the investments, and then we'll find those figures. We offset the 3 figures in the block to get the final answer on top. Okay, so for the first item, it says fixed assets purchased. So we have to look at the additional information regarding the fixed assets. It says extract from the fixed assets note. Old equipment was sold, so that 60,000 is the fixed assets sold. So 60,000 will be 60,000 sold. So that figure goes, that is seen as an inflow. So it will go without brackets. Then also it says new equipment was purchased, but no amount. So now we have to go and calculate that amount. Right? So now we have to look at the figure for fixed assets that they give us in the balance sheet. There I have fixed assets and there we have fixed assets. Okay. So what happened was I'm starting with 1 million. I'm starting with 1,302,300. Right? That's my carrying value at the beginning of the year. 1,302,300. Then there was movements. So the movements is what we want to calculate. There was an addition, which we have to calculate. There was a disposal of 60,000, which we have, and there was depreciation. The disposal and the depreciation figure, the depreciation is 71,000. I got that depreciation from the income statement information, and that gave me an answer of 1,240,800. So it says the carrying value at the beginning plus the additions minus the disposal minus the depreciation gave me the carrying value at the end. So that will be the carrying value at the end. Right. So all we have to do, we have to offset those figures and get the difference. So we start with 1,302,300. We minus 60. We minus 71. Equals 117,1300, and then we minus the answer that they give us, 1,240,800, and the answer will be 69,500. So that will be the fixed assets that was bought. So on your answer page, next to fixed assets, you're going to start with 1,302,300 minus 60 minus 71 and minus 1,240,800. Then we'll get 69,500. The 69,500 will go in brackets because when we buy fixed assets, we're spending money, so it will be seen as a cash outflow. Okay, so it's the carrying value at the beginning minus the disposal minus the depreciation minus the carrying value at the end will give me the fixed assets that we bought. Okay. The fixed assets sold, that came straight from the additional information. It says old equipment was sold at carrying value. It's seen as an inflow, so we won't have any brackets next to that figure. Okay. In the last item under the investing activities will just be the difference between the investment figures for this year and the previous year, which means the investment figures moved from 330,000 and it's now 559,000. So that will be a difference of 229,000. It will go in brackets because the investment increased, meaning that we had to put extra money into the fixed deposit. So that's why the 229,000 is seen as an outflow. Okay. And once again, we just have to offset those figures. So we leave the negative 69 on the calculator, then we just add 60,000 and we minus 229,000. That gives me a negative 238,500. Okay. So again, we offset those three figures in the block to get the net effect of the investing activities, and we write that above the block. Okay. Last section of the cash flow, again 3 lines. So it's going to be proceeds of shares issued. In other words, the amount of money that we received when we issued the extra shares. And it's going to be the amount of money that we spent, repurchased of shares. In other words, how many shares did we repurchase and what was the purchase price or the repurchase price. Then the third line will always be something to do with the loan. So again, the non-current liability, the mortgage loan, last year it was 430, this year it's 320. Clearly we can see it decrease, so it will be repayment of loan. Okay. So for those three items, we now have to look by the additional information to see if we can find any of those items over there. So the first item we're looking for will be the issuing of extra shares. So there we have a heading issued. It says that we've issued 84,000 extra shares at 7 Rand, and we received 588,000 for those 84,000 shares that we've issued. So the proceeds of the shares issued is going to be 588,000. If we wanted to, we can just have 84,000 over here, multiply that with the 7 Rand, and that's how we got the extra shares, and that's going to be seen as an inflow. That's why we don't have any brackets around it. Then the repurchase means that the company repurchased, so that will be an outflow. So now we have to look at to see if there's anything that was repurchased. They mention in the additional information 40,000 was repurchased, but that was only the average. So we're going to use that figure. Just mark this. We're going to use that figure, and in the note for the retained income, we see there the 40,000, that one over there, so we're going to use those two figures. So the part that goes to the ordinary share capital note under the issued, that is the average, and the amount that goes to the retained income was the amount more than the average. So for us to get the actual amount that we spent on repurchasing the shares, we have to add those two figures together. So for the repurchase of shares in the cash flow, it's going to be 232,000 plus the amount from the retained income, which was 60,000. That gives me 292,000. We are repurchasing the shares. It will be seen as an outflow, so it will have to go in brackets. Then the last line for the repayment of the loan, we just have to get the difference, which is the loan movement was from 430 until 325,000. So that will be my bracket over there. It's 430,000, 325,000. It's a repayment, so it's seen as an outflow. It will go in brackets, and the repayment of the loan is only 105,000. So once again, we just have to offset those three figures, and then we'll get the final answer, which we'll have to write on top. So it's going to be 588 minus 292 minus 105 that will give me a positive 191. So that is the figure that it's an inflow, so it will be shown without brackets. Right, then all we have to do now, learners, we have to take the final answer of the operating activities minus the final answer of the investing activities plus the final answer of the financing activities, and that should give us the figure for net change in cash and cash equivalents at the end of the year. So the net change in cash and cash equivalents, okay, the net change in cash and cash equivalents will be the sum of those three blocks that we have to offset. So the total of the operating activities, 63,400 minus 238,500 plus 191. And that gives me 15,900. So the net effect will be 15,900. Let's just see if there's any questions. Okay. Right, there's a question on the interest paid. The interest paid will be in brackets, so we don't have to add, you have to minus. And the same, but with the interest expense, that is the one that you have to add back. Okay. Just again, back quickly, the 15,900, that is the sum of the operating activities, the investing activities, and the financing activities. And that gives me a positive 15,900. Then the last item we have to check for will just be the cash and cash equivalents, which is the difference between that movement over there, but we need to check if there was any bank overdraft. So the cash and cash equivalents at the beginning of the year is 46,800. And the cash and cash equivalents at the end of the year is 62,700. So again, our cash increased from 46,800 to 62,700. So there's an increase in cash of 15,900, which is exactly the same as the sum of those three blocks of the financing, investing, and operating activities. That's just a checking mechanism so that you can see the difference between the opening and the closing balance of the cash and cash equivalents should be equal to the net change in cash and cash equivalents in your cash flow. Okay, just to recap quickly, the thing that was different in this cash flow was the item for interest expense and the item interest paid. In most exercises or in most past question papers, you'll find that those two figures were always the same. But what makes this one different is in your note for trade and other payables, they specifically indicated that expenses payable, interest on loan, you haven't paid 8,500 of last year and you haven't paid 6,000 for this year. Because of that, the interest expense figure in the note and the interest paid figure in the cash flow will not be the same. The interest expense figure you get from the income statement, which is 53,000. But the interest expense figure will now have to take those amounts that appears under the payables into account. That's why it's 8,500 plus the interest expense minus the 6,000. So you'll get it 55,500 and it has to go in brackets. Okay. Right, learners, I think that sums up the revision for the cash flow statement. I hope you had as much fun as I had presenting it. This is a very important section of the work, learners. You need to make sure that you have mastered this thoroughly in order for you to score very good marks in your June exam. I wish you everything of the best for your June exams and good luck. Okay, there's also a information session regarding the University of Stellenbosch, which will start at 5 o'clock. So please stay tuned. It's very important information for you. Thank you very much.